Live from Pier 3 in San Francisco, welcome to Bloomberg West, where we cover the global technology and media companies that are reshaping our world. I'm Emily Chang. Our focus is on innovation, technology, and the future of business. Let's get straight to the rundown. Day 2 is even uglier than day 1 as Facebook falls below its IPO price to close down 11%. Was the float too big or the price too high? We drill down into what could have gone wrong. NASDAQ officials admit technical problems bungled the start of Facebook trading, leaving traders in the dark about their orders. How can mere milliseconds cause such a setback? We'll talk about the technology behind the trading mishap. And the day after the IPO, it was wedding bells for Facebook founder Mark Zuckerberg and longtime girlfriend Priscilla Chan. We tell you why their nuptials could be cause for shareholder concern. But first, to the lead. After a shaky debut, Facebook plunges on its second day of trading, shares of the social network closing at about $34 apiece, wiping about $11.5 billion off Facebook's closing market cap on Friday. Now, investors, analysts, traders are all playing the blame game. Some saying Morgan Stanley priced the deal too high, others that Morgan Stanley and Facebook sold too many shares. The NASDAQ has already admitted software issues caused delays and mishandling of orders. Facebook started trading a half hour late on opening day, and the stock settled just barely above its initial offering price on Friday. Then there are also lingering concerns about Facebook's business and how it will diversify revenue streams and monetize mobile traffic. For more on what might have gone wrong, let's bring in our editor-at-large, Corey Johnson. So, Corey, has anything like this ever happened before with an IPO that was so hotly anticipated?
A lot of things like this have happened before. The NASDAQ has had tremendous screw-ups in the past, whether it was not answering the phones during the crash in '87 to squirrels eating through the cables of the NASDAQ headquarters, their central data center years ago. So they've had a lot of problems in the past. But around an IPO, I think the other thing that's happened a lot before is hot tech startups, excitable trading among retail investors piling into an IPO. And it's continued to happen well after the dot-com bubble blew up. Look at the trading of Groupon in just the first 3 days, when I think that retail investors came to expect, and indeed professional investors came to depend on retail investors to jump into the market, create that giant one-day boost, and get the stock flying, even though the result would be a stock that would sell off over time. Up until this deal, that has always been the case with these forward-facing, consumer-facing internet companies going public. You've seen these big pops in the IPO prices, and I think a lot of people in the market just depended on that happening, regardless of the deal.
So, Corey, what sort of clues are you looking at as to why this may have happened? What's the full story?
Well, look, there are a number of things that Facebook did to itself. I've created just a couple of bullet points here of things you might want to look at for reasons that Facebook did this deal. It had nothing to do with price. But, for example, there's a big, not Facebook's fault at all, FINRA changed a rule saying people couldn't put market orders in, say, buy the stock at any price, I don't care what it is. Well, that meant that people weren't buying the stock at any price without a care of what that price would be. They'd actually have to put in a limit to their orders. We had a weak market going into this. The S&P trading at 13 times earnings. That's when LinkedIn went public, the S&P was trading at 14+ times earnings. Not a big difference, but not a real strong market. So maybe people thought if they wanted risk, they could find a different kind of risk somewhere else. And then there was, frankly, the size of this deal. 421 million shares going out there. It was just a huge, huge offering.
What about the price of the deal? What are you gathering from that? And also volume. Interestingly, 582 million shares changing hands on Friday. Today, 168 million.
I think the volume really shows that today is, the first day going out, it's going to be something above whatever the offering price was initially in that first day, the offering size was in that first day. But the volume today shows you that there's still a tremendous amount of interest from people trying to trade this. I mean, let's take a look at the pricing issues really quickly here. The pricing issues with this stock. This is a very expensive stock by a lot of comparisons. Price to sales, 23 times sales, compared to the S&P at 1x sales. PE ratios, I mentioned, 96 times its trailing earnings versus 13 times the S&P. Those are really, really, really big numbers for a company. Again, this is not a nascent company. They've been around for a while. It's got a lot of size to this business. It's a profitable business, a free cash flow business, a business where we have some idea what's really possible there. To price it this high, that, you know, they could ask for this kind of trouble.
All right, Corey Johnson, our editor-at-large, thanks so much for that insight. Now, our senior West Coast correspondent, John Ehrlichman, has been looking into the ripple effect this has had on other social media companies. John, how much can the problems that Facebook is having now impact some of these other recently public internet companies?
Well, all you have to do is look at what's happened to these stocks since Facebook went public. Over the last couple of days, names like Zynga and LinkedIn, Yelp. Take a Chinese one, Renren, which is often described as the Facebook of China. I mean, in all these cases, you have seen red arrows over the last 2 trading days, more significantly, obviously, there with Renren. Look, there are all sorts of explanations. There always are. We know that Zynga got caught up in the NASDAQ trading mess as well. We know that some people may have been selling some of these shares so they could make room in their portfolios for Facebook. But I think you're right. Look, this is the big whale. This is the one that everyone was always looking to. And Corey highlighted the fact that they just sold so much stock. I mean, let's take that out of the equation for a second, and you were talking about what was seen as a new class of company that's on the fast track for the NASDAQ 100.
And then out all the cash.
Absolutely, but then on top of that, the fact that there has been this lackluster feeling all of a sudden raises these second thoughts about those other players.
What does this mean for IPOs on the horizon? I mean, will this slow the process down?
I really think it depends on which companies we're talking about. I mean, first of all, a lot of the companies that have already said they're going to go public in technology are not social media companies. What about a big company like Twitter? As far as we know, they have no current plans to go public.
Exactly.
And I even spoke to somebody who runs a hot startup and said, what do you think about the Facebook stock sell-off? And he said, oh, Facebook shares are down today. I mean, a lot of these people are head down and they got money to work with right now. But
they're thinking about Pinterest.
There you go. And you know, I spoke to one banker today, and this person ultimately said, the fact that Facebook has that monster valuation, whatever, 100-plus times earnings that Corey was just alluding to, that is what is not possible with some of the other companies out there. Whether or not they're not able to go public is another story.
Okay, thanks for that, John. Lots to watch over the next few months. So where are all of Facebook's friends now? For more on this, I want to bring in Max Wolf, a senior analyst at Greencrest Capital Management in New York. Also with us from San Diego is Bloomberg contributing editor Paul Kodrowski, a former equity analyst and early-stage venture investor who did manage to get his hands on some of the shares in Facebook's IPO. So, Paul, do you still own those shares now?
You know, you like that. That was my experiment in sort of Hunter Thompson gonzo journalism, you know, experiential journalism. So yeah, I bought some on the offer. I got 100 shares, which was part of the reason why, you know, early in the morning when I saw the email from E-Trade that I'd gotten the offer, I said, oh my goodness, this is bad news, of course, because, you know, the old adage with Wall Street is, you know, if you get what you want, you shouldn't want it. And I got what I allegedly wanted, which was to say a full allocation, 100 shares, which is what I had asked for of Facebook. And that usually tells you that, whoops, you know, I shouldn't have wanted that because they shouldn't have given me the full allocation, which was, I think, an early sign that they were just shoveling stock out the door at the last minute to retail investors and just trying to, you know, get the stuff out. So anyway, so you know, as is time-honored American tradition, right up there with apple pie, I flipped it as quickly as I could, hung on to 20, in part to punish myself, and in part just to see what happens next.
Well, it's interesting. We're hearing that from a lot of traders who said, wow, I didn't think I'd get this much. Some actually got more than they asked for. Max, the blame game, obviously, is happening now. Is it NASDAQ's fault? Is it Morgan Stanley's fault? Does it have something to do with Facebook? What do you think?
It looks to me like Morgan Stanley and Facebook were the most impressed by their roadshow of all people out there, and that's always a bad sign. It's always a little bit difficult to be invited to a party where the hosts are the most sure that it's a great time, and that's often an evening that ends with some difficulty. In our case, a Friday afternoon and a Monday that ends with some difficulty. That being said, we continue to think it's a very exciting company with a bright future, charts its own course for the next 18 months. It just does so in a world starting at 11:30 on Friday afternoon where it's real money, so purely fantasizing about possible future realities for the company becomes a kind of different equation for people to undertake when it's real money going out the door in a real trading account to buy the shares.
Paul, what do you think? I mean, is this purely a technical problem, or does this have anything to do with Facebook's fundamentals?
No, I don't think this has anything to do. As a matter of fact, I don't have anything to do with Facebook's fundamentals, and I'm getting a little bit sick and tired of the sort of the wise guys with the ex-post stories about how it has everything to do with Facebook and nothing to do with NASDAQ or Morgan Stanley or anything else. I mean, this just speaks to the fragility of the initial public offering system that, you know, at hot IPO had all kinds of technical issues coming out. Its underwriters tried to support the issue through close of trading on Friday, discovered that was a very expensive proposition, found someone else better to blame over the weekend, i.e. NASDAQ, bailed out today. The stock broke through its offering price, and now we're back to deciding whether or not, on the basis of, you know, earnings prospects for the company, it's reasonably valued. And I think it's, you know, somewhere between probably $25, $31 in there somewhere. This isn't a bad, you know, this isn't a bad offer at all. But, you know, sitting there saying that this has something to do with some new information about Facebook that we didn't have Friday morning and we do now is just nonsense.
Yeah, I also wouldn't agree with that.
Max, would you agree with that? Okay.
Yeah, no, that's why I didn't say that. But I do think that the earnings of a company and its profitability do matter. And ultimately, you can't buy just a dream. You can't trade a dream. You can't buy a dream. And I think if it was just technical, we would have seen today strengthen on a relief rally as opposed to see further weakness. I think sooner or later, people do care about things like revenue growth, and I think they probably should, as well as earnings. So I would agree that every asset has a price. This is an exciting asset, and we're certainly excited about it. But the idea that whatever goes wrong couldn't possibly be Facebook was part of how we got to a valuation range where people would yell at you for being conservative at 100 times earnings.
Paul, what are the lingering consequences of this going to be? I mean, can Facebook recover? How long is it going to take to get back to more of a natural price?
Oh, I think it'll happen remarkably quickly. I think we're going to flush out a lot of nervous people with the trading of the last, well, certainly today's trading and what happened on Friday. All of a sudden, it'll be damaged goods, kind of like Google was around the time of its IPO, where it's like, oh, this is very scary. Retail investors need to think carefully. Which, from the standpoint, if you're looking forward, pro forma earnings, say $1 this year, $1.50 next, or whatever the case may be, on the kind of earnings growth we're seeing, it doesn't look particularly expensive on those terms on a pro forma basis. If you look forward based on those kinds of earnings prospects at $30, $28, somewhere in there, it starts to look reasonable again pretty quickly. So again, I think this is largely technical, and and it's highly entertaining. But I think looking forward, all this is really doing is flushing out a lot of people who were probably in there entirely speculatively in the first place.
Okay, Bloomberg contributor Paul Kudrowski, Greencrest analyst Max Wolf, thank you both for weighing in on this hot topic of the day. Now, as we mentioned, Facebook's first day of trading plagued with technical problems, leaving traders unsure of whether their orders had even gone through. So what went wrong at the NASDAQ in particular in such a highly anticipated IPO? That story is ahead. And for all the latest tech news, don't forget to check out our tech channel, Bloomberg.com/technology. Welcome back. I'm Emily Chang. Yahoo took a major step forward overnight, cutting a multi-billion-dollar deal to sell half its stake in Alibaba back to the Asian internet company. The deal's price tag, $7.1 billion, money Yahoo plans to return to shareholders. This also sets the stage for an Alibaba IPO. Our John Ehrlichman's been following the story all day long. He joins us again with the latest. John, what do we know about this deal?
Well, you know, Emily, obviously this is a major development for Yahoo, and yet this is a company that's in transition, right? They've got an interim CEO. We know what just happened with Scott Thompson. The catalyst, you could argue, in all this has always been Jack Ma, the guy behind Alibaba, who sold 40% of his business to Yahoo for $1 billion back in 2005, and you could argue has been kicking himself ever since because the value has just gone up and up and up. And obviously they have been trying to work out a deal for some time. Last year it seemed like they might be close in getting some kind of deal structured where they would avoid a big tax bill. That didn't work out. We got hints from Scott Thompson recently that they were working on a simpler deal, and indeed this is what they're doing. And they sell half their stake basically now, and you deal with the tax consequences, but you get a lot of cash back that you give to shareholders. And then potentially, as Alibaba gets ready for a splashy IPO, there's a potential for them to participate in the upside there too.
John, doesn't this also open the door for Yahoo to focus more on its own business, which clearly needs a lot of work?
Oh, yeah, that thing. Look, you're absolutely right about that. I mean, how much have we talked about the Alibaba story instead of talking about the fact that Yahoo has to continue to focus in what it's going to do versus the likes of Facebook, which we just discussed, and Google. And yet, on the other side, think about the fact that this has been that hidden gem, the way that they could distract if they were concerned about what was happening with the underlying business. Now, for all things Yahoo, I want to bring in a guest from New York, Brett Harris of Gabelli & Company, who does have a buy rating on the stock, to get his reaction to this deal. And Brett, what do you think? Is this the best move that Yahoo could have made?
Yeah, I think this is a very good move. As you mentioned, there's a downside, which is they have to pay taxes. But on the positive side, they get to monetize half their stake in Alibaba Group. And going beyond that, it puts Alibaba Group on a path for an IPO, which is very good and gives Yahoo a little bit of cash to buy back shares.
Let's talk about what that IPO could mean. I mean, we mentioned this is a business that Yahoo acquired 40% of in 2005 for $1 billion. The discussion generally is around $35 billion for the whole Alibaba pie. What do you think the business is worth?
Right. Well, that's the hidden gem, is that you've got a $35 billion business now as a private company, and as a public company, it could be significantly higher. So even assuming just taking the $35 billion now, Yahoo owns 40% of it, it's about $14 billion, or call it 9.5 after taxes. But if they do go public and you see a significant increase in the valuation, both on the IPO and then afterwards in trading, Yahoo is going to be able to make a healthy return on the stake they are keeping.
I mean, are you already guesstimating that it's worth more than $35 billion?
Well, at this point, the way we think about it is if you value Alibaba Group at the $35 billion, you're getting Yahoo US for free. So anything above $35 billion is really it's really just incremental value for us at this point.
Gotcha. Now, people reading the headlines today might think that this is the first move towards an exit. No more relationship between these two companies. They tried to say, no, actually, we're going to have potentially a better relationship. We're going to try to collaborate. Give us some ideas on how Yahoo and Alibaba might be able to work together in other ways.
Well, I think they talk about the future relationship they could have, but it's really about exiting for Yahoo. We've seen the relationship between the two companies be strained over the past 3-4 years, culminating in the Alipay restructuring that we had, I think it was the beginning of 2011. So, I'm sure they'll be able to work together, share technology, but this is really about Yahoo taking a step back, monetizing its assets, being able to repurchase shares, and then turning its focus really to its U.S. business.
This happens quickly under Ross Levinson's interim CEO watch at Yahoo. He actually didn't field many questions on the conference call today, left much of that to the CFO, Tim Morse. What do you think of the job Ross Levinson's doing so far?
Well, it's a little bit too early to tell, to tell you the truth. Tim Morse, of course, has been through this before, and he is significantly more confident, I think, on this call than he was during his last CEO transition. So it's good to have a guy like Tim able to step in and handle the ship while Ross gets up to speed.
Hey, Brett, thanks a lot.
Thanks for having me.
Brett Harris of Gabelli & Company joining us from New York. Emily, back to you.
Thanks, John. Coming up, Google Chrome is gaining ground over Internet Explorer, but does Microsoft have reason to worry? That is next on Bloomberg West. This is Bloomberg West. I'm Emily Chang. European regulators have given Google several weeks to come up with proposals to fix alleged antitrust violations. If Google doesn't come up with its own remedies, the search giant could face more investigations and fines. The EU says Google promotes its own search services over others and stifles ad competition. Meantime, China has approved Google's purchase of Motorola Mobility, the last big regulatory hurdle in that deal. Reports say Google got approval after it pledged not to charge for its Android operating system for 5 years. That means the deal could close by this Wednesday. And it is time now for our 3 for 3 segment, 3 people, 3 stories in usually about 3 minutes. John and Corey here as well. So the first story of the day, Google Chrome passing Internet Explorer over the weekend.
That's shocking.
In terms of traffic, I thought that was really interesting.
I doubted the story when I saw it this morning, but you go back and look at the trend, and you can see a very clear trend of Windows Explorer is coming off from what had been a 70% market share, and Google Chrome picking
They're
up.
close, though, right?
It's about 30, 30, 30.
It's like the Beltran Matt Kemp home run race, right?
They're close, and to be fair, this is data from just one weekend. So everyone is being cautioned not to take it as permanent.
And like Matt Kemp, Internet Explorer is coming off the injured list and could start resuming hitting again. Because with the new Windows, it's going to be very important to see how many people who were just unsatisfied with the old Explorer will want a new one.
That would seem to be one of the takeaways, that when people sneak home, they Chrome, as opposed to at the office when they're using Internet Explorer. I don't know. I think.
And also Chrome integrates with a lot of Google's products now, and they make it such that some features are initially only available on Chrome, and so maybe it's not necessarily always a choice.
And like Carlos Beltran, with Lawrence Berkman hurting behind him now, could be out for the season. That could be bad news for Google.
Okay, on to more tech news. 5 of the big cable companies sharing mobile internet hotspots. This includes Comcast, Time Warner, Cox Cablevision, and Bright House. This is interesting in that this is a time when the cable companies are trying to differentiate themselves, and yet this is like the biggest roaming agreement ever.
Yeah. Well, I mean, they're kind of holding on to the same customers, and the cable companies don't like that the phone companies moved onto their turf, and then this is a move to go back that way too. But I think it's important because nobody wants to pay additional wireless fees if they can avoid them. I think this is one of the challenges with phone companies too, when you go in and buy an iPad or whatever at the carrier, and people don't sign up for Wi-Fi because they forget that they have to pay those additional fees too.
I think this announcement is a trick. I think there's a fake announcement because they partnered. Well, no, because they partnered with Verizon.
Corey Johnson.
They partnered with Verizon in this thing. So they're saying, hey, we're going to offer an alternative to the phone companies, although we're going to give wireless spectrum to Verizon. What this means is they can't undercut the price of Verizon, which is exactly what consumers should want, right? I would love it if my phone would switch to a cheaper Wi-Fi plan instead of the expensive Verizon plan, for example. That won't happen with this deal.
Well, 3 of the companies did do a similar deal a couple of years ago, and it had sort of limited impact. So that's one we will be watching. The third topic, Hulu debuting 3 original series just in time for summer programming. Some quirky programming as well.
The only one I saw was Kevin Smith doing like a movie review show, which I would watch.
A movie review series, a travel series as well.
Well, but here's the thing. So I think we're now thinking of all these services, Hulu, Netflix, very much like the HBO. Like, you will buy the service based on that one show if they can come up with the hit show. The same way that you know, cable, you go for ESPN or Bloomberg Television, of course, if you can get the hit show.
So interesting. Going head to head with Netflix, of course. Thanks, guys. Coming up, IPO, no. Facebook stock hitting the red, and the NASDAQ CEO red in the face after admitting fault in delaying trades for the social network's IPO debut. We'll tell you what went wrong and how it could possibly happen again. You are watching Bloomberg West, where we focus on technology and the future of business. I'm Emily Chang with your Bloomberg top headlines. 2 of the most powerful CEOs in technology are meeting face-to-face today to try to resolve their patent dispute. Apple CEO Tim Cook met with Samsung CEO Choi Ji-sung in court-ordered talks. The judge wants a settlement before a July trial in which both companies are accusing the other of infringing their smartphone and tablet patents. A Chinese conglomerate says it will buy the AMC movie theater chain for $2.6 billion. The Dalian Wanda Group says it's planning to spend millions to improve AMC's theaters. The acquisition is the largest takeover ever of a U.S. company by a Chinese firm. And former Yahoo CEO Scott Thompson has resigned from another board. This time he stepped down from the board of the software company Splunk. Last week, he quit the board of F5 Networks just after being bounced out of Yahoo for misrepresenting his college degree on his resume. He also revealed he had health issues. Now, Research in Motion had a good day. What made the BlackBerry maker shares spike today? For more on RIM and today's other tech movers, aside from Facebook, let's head over to our senior West Coast correspondent, John Ehrlichman. John.
Emily, this move in Research in Motion today has much to do with one of the legal fights that RIM's been involved with. This percentage move, by the way, for RIM today, the most significant since March. And actually, this news gave Apple a bit of a boost, too. So basically, a judge ruled that a 2-year patent fight between Eastman Kodak, which of course is in bankruptcy protection right now, and Apple and Research in Motion went in the direction of Apple and RIM. And that does raise questions about Kodak as it looks to sell its patent portfolio, but for the meantime, it was helping those two stocks. Another stock that was benefiting today from some positive buzz, Disney. Over the weekend, seeing its Avengers flick top the all-time numbers, if you will, for box office for a Disney film. It's now the gross in the last few weeks near $1.2 billion for the Avengers, and that has certainly helped Disney shares. And finally, just a quick look at what happened with Google shares today. Google a little bit higher. Remember, on Friday, they were part of the sell-off when investors weren't that interested in buying Facebook. But, you know, one of the things we heard on the IPO roadshow tied to Google was that the Facebook strategy was actually giving some investors the idea that maybe they should add some Google stock to their portfolio, given where Google trades valuation-wise compared to Facebook. Emily?
All right. Thanks for that, John. Now, NASDAQ CEO Robert Greifeld has apologized to Facebook investors frustrated by Friday's 30-minute trading delay. Greifeld blaming the technical glitch on poor software design. The error resulted in a series of late-order cancellations, overwhelming the stock exchange and preventing shares from being opened on schedule. Our editor-at-large, Corey Johnson, back with more on this from the newsroom. Corey?
Yeah, Emily, the NASDAQ's embarrassed, says their IPO system will be redesigned, but could this happen again? What are the secret forces driving the NASDAQ? Well, Bart Chilton, Commodity Futures Trading Commissioner, joins me now from Little Rock, Arkansas. Bart, the NASDAQ couldn't blame squirrels this time, could they?
No, not this time. There's all sorts of reasons why these things happen, Corey, and you know, obviously NASDAQ screwed up. I guess their social network went down, and they're having a tough time friending anybody today. But the point is, the larger point is, technology in markets isn't always what it's cracked up to be. I mean, of course it's miraculous. There's 160 million financial transactions taking place every single day around the world. But we have problems like the NASDAQ issue and other problems. There's many more of them that are occurring. And I think, you know, as regulators and as investors, people need to take a little bit of a step back and say, is there more we need to be doing?
Yeah, there was a lot of squawking by people at the New York Stock Exchange about how they could have done it better, or the specialist system that, while it's heavily technology-oriented, at the end of the day can rely on an individual, that it wouldn't have happened there. But is this sort of a function of the markets, where as the markets get bigger, that we see an IPO offering that, you know, the Facebook offering was as big as the New York Stock Exchange traded 10 years ago. Is that just what happens, that the market expands to fill its capacity, and then the capacity has to expand again to catch up? Or is there a bigger problem here?
Well, I think it's both, Corey. And by the way, neither the New York Stock Exchange nor other exchanges, even the ones that we regulate in Chicago, are without problems in technology. We remember the flash crash from 2010, and the New York Stock Exchange had a problem with their feed because they were upgrading their mainframe. The Chicago Mercantile Exchange, a year ago last fall, they put some information, some trading information that was for a test into the live production environment, and some people lost money. So all of these exchanges are having problems. To get to your question, there's lots more trades. Like I say, 160 million transactions, financial transactions per day. And it's these traders in large part that I call cheetahs, these high-frequency traders. And cheetahs because they are so fast, fast, fast. And they're just trying to scoop up microdollars in milliseconds. And I'm not saying they're bad, but they're new to the market, and there's bound to be problems. And Corey, if you can believe this, they aren't even required to be registered at the SEC, at my agency, the CFTC. So we've really got to get on the horse and ride on this one and do a lot more than we've done heretofore to date.
Well, and this is, of course, a really big issue, I think, for a lot of companies in our world of technology, not from a supplying to the exchanges and so on, but from the way that the high-frequency trading impacts their share prices on a given day and adding to the volatility. Do we know how high-frequency traders might have affected the trading in Facebook shares in the first 2 days?
No, I don't know anything about that specifically, Corey, but I can tell you in general that the claim is from these cheetah traders, the high-frequency traders, that they add liquidity. And of course they do, because somebody's on the other side of those trades. But it's fleeting liquidity. So if you're in the commodity markets, for example, and you're a farmer and you want to hedge your soybean crop for 5 seconds, we've got just the guys for you. So are they adding long-term liquidity that's deep liquidity that helps markets? I question it. Again, I'm not saying they're bad, but regulators at least need to know who these folks are. The third largest trader, Corey, by volume at the Chicago Mercantile Exchange is one of these cheetah traders in Prague. I mean, we're never going to get any books or records from Prague, from these traders. I'm not saying they've done anything wrong, but we've got to get a better handle on these guys, and we need to know who they are. The first step is registration.
Is this an SEC issue? Is the SEC asleep at this, quite literally at the switch?
Well, no, these are technology issues that all the exchanges have. But what I keep saying on all these issues is that, you know, regulators, the SEC, the CFTC, the bank regulators, that we just sort of expect that the exchanges will do something. We sort of expect the banks will do something. Really what we're learning is what they'll do is what's inspected, not what's expected. So we just need to have a little bit more clear view of what's going on, ensure that people, customers, and our economy aren't impacted by these negative events that we've seen.
All right, Bart Shelton, CFTC Commissioner, thanks for your time today. We appreciate it. Emily?
With you.
Thanks, Corey. We're actually getting some breaking news on Yahoo now. A former Yahoo executive and a former mutual fund manager being accused of insider trading. Apparently, this Yahoo executive gave this trader inside information that a deal between Microsoft and Yahoo was about to be announced, and the trader made almost $400,000 based on this tip. Those are some headlines, and we'll continue to follow those as they cross. Now, it was supposed to be a historic space launch, but ended up getting scrapped at the very last second. What is next for SpaceX? Coming up on Bloomberg West. Welcome back. I'm Emily Chang. Sequoia Capital's most well-known partner is taking a step back from management duties after being diagnosed with a rare illness. Mike Moritz will now spend less time dealing with daily tasks involving things like legal, real estate, and recruiting issues, and more time investing. In a statement, Moritz, who's 57 years old, said his condition can be managed but is incurable, adding, "I've been told that in the next 5 to 10 years, the quality of my life is quite likely to decline. I hope that I'll be one of the lucky ones who can live a full life and defy the statisticians." Moritz has been a fixture in Silicon Valley for 2 decades, first as a journalist, later as a venture capitalist backing internet pioneers like Cisco, Yahoo, and Google. Sequoia says Moritz will continue to make new investments and take new board seats and will remain on the boards he's already on, but will be taking a few more weeks off every year. SpaceX is going to try again to launch its latest rocket tomorrow. This after the last attempt was aborted in Florida over the weekend at the very last second.
4, 3, 2, 1, 0, and liftoff. We've had a cutoff. Liftoff did not occur.
The launch was stopped after a computer detected an engine pressure problem. The rocket is carrying the first unmanned commercial spacecraft to the International Space Station. SpaceX is run by Elon Musk of PayPal and Tesla fame. Earlier, Corey got a look at SpaceX headquarters with Musk as his guide.
Our mission control. So we have launch control at Cape Canaveral. Right. And then once our Dragon spacecraft is delivered to orbit and it's on its way to the space station, then we transition to mission control. This is effectively like our Houston. Right. And in fact, we will be in direct communication, like linked with NASA Houston and SpaceX Hawthorne in conducting the mission to the space station.
Will SpaceX be successful tomorrow at getting its history-making spacecraft into orbit? Be sure to stay tuned to Bloomberg West for all the details. We turn now to our partnership with Planet Forward, a program that brings experts and leaders together to create innovative projects in areas of energy and sustainability. Today's innovator is the University of Maryland. Researchers there are working to improve two universal frustrations for smartphone users: battery life and signal strength. But rather than convenience, their motivation is safety. Planet Forward's Frank Sesno explains.
In our wireless world, you're nowhere without a good battery and a solid connection. But wouldn't it be better if we could improve both and use less energy? One team at the University of Maryland uploaded an idea to Planet Forward. Their motivation, they say, is safety, noting what can happen in an extreme setting to a lithium battery that's been deliberately shorted.
Clearly, battery failure is no joking matter.
The Maryland team says their technology, which puts a solid polymer in the middle of that battery, would prevent the explosion and be better for the environment.
Current batteries have to be disposed in a certain way because the liquid electrolyte, which is the toxic material that we're trying to replace, can leach out of the battery. So our technology will result in a battery that will be all solid. So it will be definitely more sustainable.
The Maryland team has set up a company to take their technology to market. They're talking to a major battery manufacturer. Other scientists are doing this too, though, so the race is on. When we visited, we learned that they're leveraging their work into other devices as well. Check this out. It's a flexible antenna.
It looks like the rubber in your tire, but it has unique properties. It's a magnetic material. So the advantage is that it can be coated, it can be shaped anywhere where you like it. It doesn't have to be a flat device, so you can use your casing of your cell phone as your antenna.
And if you look at another video they showed us, you can see the possible future of food safety. Look at the reaction in this simple petri dish, which we've speeded up. A polymer is changing color in response to the simulated presence of a dangerous bacteria. To be sure, these innovations in polymer are a couple of years away from your local store shelf, and there's a lot of competition. But with funding from a variety of sources, including the U.S. military, the Maryland team hopes their research can help move the planet forward.
And we're joined now by Frank Sesno, director of the School of Media and Public Affairs at George Washington University. He is in Washington. Frank, welcome back. So what is the advantage of polymers for this kind of work exactly?
Oh, the advantage, there are a lot of them. And what's really interesting, you know, you remember the movie, maybe before your time, Emily, The Graduate, 1967, you know, the guy...
I've seen The Graduate. Of course I've seen The Graduate.
One word, plastics, right? Well, that's what polymers are. Polymers are plastics. So we put the plastics in the middle of the battery. We put the plastics, and we can now mold them and turn them into antennas like you saw there. You can put plastics, I don't know if this sounds so great, or something like it, in a food so you can determine when the bacteria there and the stuff is bad. In the battery, it saves about 30% of space, weight, and energy. That's a very big deal when you're trying to pull the weight down in a plug-in hybrid electric car or something like that. In these other things where they can craft them and shape them, you can save space and therefore production money with the determining the bacteria or something bad that's in food. This is a passive system, so you don't need energy to go testing, and you actually are much more efficient with the food supply because you could put these little things in there and see exactly which items are spoiled on the shelves. So rather than throwing everything out, you pick the ones that are bad, although we don't want anything bad on the shelf. So there's a lot of advantage in this stuff.
Interesting, Frank. Good to know. Thanks so much. Planet Forward's Frank Sesno. Thanks for joining us. And if you have an idea you'd like to submit to Planet Forward, visit planetforward.org. And for more environmental and sustainability news, make sure to check out Bloomberg.com/sustainability. Coming up, Facebook CEO Mark Zuckerberg drops his signature hoodie for a suit and tie in a very special celebration this weekend. So, should shareholders be concerned? That is next. This is Bloomberg West. I'm Emily Chang. Facebook CEO Mark Zuckerberg capped off his busy week by marrying longtime girlfriend Priscilla Chan in a surprise ceremony at his home in Palo Alto on Saturday. Wedding bells rang for the couple just one day after Zuckerberg rang the NASDAQ opening bell. Our Bloomberg West editor-at-large, Corey Johnson, has more on this from the newsroom. And Corey, there's actually a business story here as well, right?
Perhaps. Joining me in unholy interview matrimony, Vicki Ziegler, divorce attorney and author of The Premarital Planner. Vicki, let me start the whole thing by saying congratulations, Zuck and Mrs. Zuck. We wish you a long life together, sincerely. But I wonder if the timing of this strikes you as intentional.
I think potentially there may be something here underlying this particular date of marriage. I mean, it makes it strange coincidence that the IPO happens and then they get married a day or so after. So I think it was a very smart move by Mr. Zuckerberg, who probably spoke to a divorce attorney or two if he doesn't have a prenuptial agreement, to make sure that the valuation is set and that, quite frankly, his premarital asset is actually preserved.
Yeah, I mean, I think one of the important things is
I can't hear anything.
Nothing else about this IPO at all seems to be accidental. The timing, there's a lot of discussion about tax sales and about the lockup period ending for the tax period. So I got to wonder that or assume that he's taking a complete look at all of his assets and understanding what assets are his premaritally and what assets are not.
Having trouble with that interview. The guest could not hear you correctly, so we're going to head to break, and we'll be back in a few moments. Welcome back to Bloomberg West. Let's head back to Corey now with that interview. Corey?
All right, Vicki Ziegler, hope you can hear me now. All right, the whole deal was not accidental. Everything seemed to be planned, tax assets carefully planned. What would be the advantage to waiting until after the IPO to get married?
Okay, so the first thing is obviously any of these stock options, any of the additional shares that he's going to purchase after the date of marriage will be the marital portion. Anything that obviously was acquired before they actually they went down the aisle, is going to be separate and apart. The question I really have from a financial perspective, if there is no prenuptial agreement, in the event he dies, right now she stands to inherit the bulk of it unless his family would contest. So those are some of the questions that I'm asking right now. There's retirement, there's stock options. All of those things are fair game if there's no prenuptial agreement in place, which to me would be ludicrous for a man like this, who's one of the wealthiest young men in the world.
Well, and also with this company, it's very unusual for shareholders because it's what's called a controlled company. Mm-hmm. He owns and controls the majority of the shares, separate owning and controlling them. So this, I think, is a matter that affects all the shareholders. If that holding were to get split up, the entire corporate structure could change for this company. I
mean, this could be a financial carnage situation in the event of divorce without a prenup. And even if there was a prenup, quite frankly, he owns, I think, 28% of this company. He's the voting majority shareholder. But at the end of the day, the books, the records, the flow of his income that's received would be analyzed. And that could be devastating. Even the key people that are running this company would be deposed. I mean, it would be, $10, 20, 30, $40 million endeavor to try to figure out what Priscilla Chen ultimately would be entitled to. So I think people really need to kind of take a step back, hope that he did some premarital planning, like I talk about and write about, and ultimately stays happily married forever, quite frankly.
Have you seen people who should have done premarital planning and don't, however?
All the time. That's why statistics show first marriages end in divorce in about a 50% bracket, second time 62%, third time 74%. So obviously people are in this vicious financial cycle. They're not being smart about getting married. They're not taking those important tips. They're not really talking about money, the smart things that marriages need to work on and talk about before you actually get married. And that's why the statistic goes on, and that's why divorce attorneys like myself are honestly in business. So we want to really help people. We want to have some humanity and make sure that people are talking about the right topics before they get married, so when things do crumble or an issue arises, they're ready and prepared for it.
I know you're in New York. Is there anything peculiar about California law as it relates to this deal?
Oh, absolutely. It's a community property state, one of only 9, I believe, which means if, in fact, there is no prenuptial agreement, everything that's maritally accrued after that wedding, after that Saturday wedding, is going to be shared 50-50 unless Mark Zuckerberg can prove it was derived from premarital earnings, income, or from his company. And you know what? She can fight, and I don't think any judge in America is going to feel bad for Mark Zuckerberg in the event of divorce, quite frankly. Say they have children, there's a child support issue, alimony, a whole host of issues that he's going to have to handle if there's no prenuptial agreement.
Okay, Vicki Ziegler, divorce attorney. I'm so glad we could reunite and our separation was not final. Thank you.
Thank you, and I was nice to you, see?
We do, of course, wish Mark Zuckerberg the very best.
Yes, we do.
They've been together since college, since before Facebook was anything, and they've obviously been through a lot together.
I would think they've discussed money.
I would think they've discussed it. They've had a lot of time. They've been dating for 8 years. The bite quickly is
1,700.
Okay.
Looking forward to tomorrow. That's how many employees SpaceX has. So this is not some like crazy project by some rich guy with a bunch of dynamite and a rocket. Big company.
All right. Well, we're excited to see what happens tomorrow. We'll be back.